Hello, and welcome back again. We're continuing our series in which we're evaluating big tech companies, the FAANG, and this one is going to be Apple. So Apple is a company that I wanted to own since forever, but I haven't gotten the chance because it has been expensive for the most part. Now, we're going to be taking a little bit of a look as the stock price you'll see in the last 6 months has been climbing, is the thing, and it kind of scares me a little bit. But we still want to be examining what is happening because things change in regards to earnings as well. And so as the company generates new earnings, their stock price, although higher, it could be relatively cheap compared to the earnings that they are having. And this is what we care about. We don't really care about the actual stock price per se. We do care about the stock price when we associate it with the amount of money that the company generates and how well they are doing business like. Now, if we take a look at the 5 years chart, you will notice an uptrend. Of course, there have been some downtrends in between, but for the most part, it has been a consecutive uptrend. And more than likely, I think this is going to be continuing for the future of Apple, but that doesn't mean that we want to be buying at any point. So what's the point and why we could be buying right now or not? Now, the first thing that I wanted to show you, and I mentioned it in a previous video as well, is this little diagram here, which tells us that Apple has grown about 800% in the last 10 years, and that is almost 700% more than the S&P 500 index fund, which is 128%. Now, this is also a little bit scary if you are an owner right now, because when a company grows that much, at such a tremendous rate, there are two problems. One of the most important problems is the fact that at some point the company becomes too big to keep growing at a similar rate. And so you may actually yield much less. It may yield much less than what it has yielded in the past 10 years. Now, this much less could be half of that, for which I would be pretty interested to get as well. So it's not like 300% is bad at all, right? In the next 10 years, if that could happen, that would be pretty nice too. But there is also the fear of the company going sideways a little bit. And if that happens, all this growth that you have seen through the years, like this 800%, 400%, could become like 60% loss at some point. It's very likely, and this happens a ton with companies, especially companies that go astray for a little while. And this doesn't mean that they would go bankrupt or anything, but it could go down for a while and then continue pretty much at its normal pace if the company has some issues in a specific calendar year, for instance, fiscal year. So, in regards to Apple, there have been quite a few articles, and actually this one is talking about how Apple is not a buy right now. This is interesting to see the FAANG stock to avoid like the plague in October, pretty much mentioning that the company hasn't been doing that well in regards to their latest iPhone. It has failed to wow consumers or investors, but the thing is, it's almost a habit. Like the iPhones are almost a habit right now, and I don't think this is going to be going down anytime soon in regards to how popular the company is. And yeah, Mac sales have been hit hardest, which are down 24%, iPad down 1%, so there has been a decline. The problem that I'm seeing, because I don't really care about like a decline in a specific, for instance, year, because this could easily come back, especially when we're coming off of a pandemic year. The problem that I'm seeing is the fact that the company stock price has been increasing. And I don't like to see that. Even though the company has been having some hurdles, the company stock price has overall been increasing in the past year. Again, there has been a little bit of a decline, but look where we're coming from. And so, yeah, there has been a significant steep increase over here. Now, that's not to say that the company is not a buy, because we're looking at a P/E ratio of 30 almost here and a 25 for a price to free cash flow ratio. And you may see this being red because the base price, basically the threshold, is 20. Everything above that is going to show as red. But it's always relevant to the company as well, because when we're looking at a high growth company, a company that doesn't have debt, a company that has fantastic margins, that is growing at a tremendous pace, paying a little bit of a higher P ratio or a little bit of a higher price to free cash flow ratio, paying for this is fine. Again, frankly, it's fine as long as the company is doing well. But that doesn't mean that we are buying just because there is a PE ratio of 30 or a price to free cash flow of 25. We need to evaluate the cash flows as well and see whether it makes sense to be buying, and also what else is going on with the company. Like the fantastic thing that I love to see, we do know that they have been buying back shares, a ton of shares, 20% down. That's insane. The amount of outstanding shares that they have been buying are a lot, and they keep buying. And yeah, as an owner, as a stockholder, I would be pretty much fascinated by that, and I would be very, very happy to see. Now, the revenue growth of the company hasn't been tremendous, but we're coming off of insane increases anyway. Like the company has been doing tremendously through the years, and at some point you become so big that it becomes almost impossible to be growing at a tremendous rate, is what I talked about earlier. 5-year net income growth 67% over here, and free cash flow growth 73%, and the total equity growth is going down. It's a thing that for which I've talked about in a dedicated video in the past. Apple is doing that on purpose because they were getting debt on purpose. They were lowering their assets on purpose again because they were getting pretty much free loans, low interest loans. And what they were doing is getting this money, for instance, buying back shares and basically minimizing their assets. And so their equity is going down. That's not a problem. That's done on purpose, and it's done by design. And you will see it also in the financial statements. Again, I have made a dedicated video in my channel about the why Apple's equity is going down. Now, taking it back to 10 years, you will see the thing that we kind of saw with Google as well, at a lower level here, but still, a revenue of 171 billion to 394 billion, almost $500 billion is what the company is generating right now in regards to revenue, which is insane. And the net income from 37 to 99, almost 100 here. And again, I've talked about it earlier in my video, the video that I made about Alphabet. Take a look at the earnings per share from $1.3 to 6.15. Fantastic. If you bought 10 years ago, your investment has intrinsically more than 5x already. And you may not see that in the price, but you may see that in the price. And I think for Apple, you definitely have seen that in the price. But the thing that you bought is actually intrinsically worth more than practically worth more because it's generating more net income. And so this is exactly what you want to be seeing as a shareholder, with the diluted earnings per share pretty much being the same, about the same, as expected. Now, the balance sheet of the company is what I talked about earlier, and you can kind of see that the total equity has been going down, 107 to 50 over here. And again, it's because the company has been doing that on purpose, and they have been increasing their liabilities, cutting down on their assets on purpose. And it's something, again, that I have talked about in a dedicated video. If you're interested, you can find it in my channel. It's pretty much about Apple's equity going negative. And cash flow statement. You will see net income 60 billion to 100 billion, what I talked about earlier. That's 2018 here. Again, we can take it back to 10 years if you are interested. And you will see that the free cash flow from 44 billion, or 45 almost, to 111 billion. Fantastic increases here through the years. Again, in a 5-year period, fairly solid over here. Now, all these things are great about Apple. There are some concerns, like for instance, the fact that Tim Cook, as an insider, of course, sold a lot of stock. And at the point where, there have been some rumors about the latest Apple products not being the greatest, and, they haven't achieved as much hype as before. And so here in the 41.5 million after taxes were deducted, he sold about 511,000 shares of Apple stock, which were worth 88 million after taxes. A hefty payday for the government as well. Curious timing, again, because of the issues that Apple has had, banned government workers from using iPhones in China, things of that sort, and sales potentially going down, as we saw, for instance, with Macs. It has been a little bit of a curious period, but the thing is, executives, high executives, CEOs, CFOs, pretty much everybody, they keep selling the stock that they generate, that they get out of the company, because it's part of their salaries, frankly. Especially in California, in the Bay Area, for instance, companies pay their employees with stock. Like employees typically get some base salaries, and then their core payouts tend to be stock because it's cheaper for the company, frankly. And also, as long as the company does well, and companies like that sort have been doing tremendously well, it keeps employees happy because they see their stock going higher and higher. And it never stops, frankly, till we get some sort of a weird recession, I suppose. But it's a win-win for everybody, or it has been a win-win in the past like 10 years or so, a little bit more, like 15. And so this is what companies are doing, and they do that a lot with executives as well. It's not like they're paying them $40 million. He may, actually Tim Cook, I don't know his exact salary, but he may be getting like $1 million a year. And then he's getting like 80 million in stock. That's how it works in the Bay Area. That's how they do it. And again, it has, there are multiple reasons for this one. And yeah, there has been a little bit of a concern. I wouldn't be concerned about this one. The thing that will concern me is if they sold disproportionately more shares than what they have been selling in the past, especially if they have a lot, for instance, and they sold a lot, or if the CFO, the Chief Financial Officer, sold a lot. I would be concerned for sure. But other than that, it tends to be sort of like a calendar. It's almost a thing that they do every quarter, just selling their stock. That's how it works over there. Now, we're going to go back and take a little bit of a look at our discounted cash flow model. As usual, stock evaluator here. The company has been growing at revenue growth, a 5-year average revenue growth of about 12%. And we do know that it is a behemoth, and so we're going to go lower than this, just to make sure. So we're going to go, let's just go 5, 7, and 9 here for Apple. Net income margins high, obviously, for a company of that sort because of the services too. And also they're expensive, their products. And so we're going to go 20, 23, 24, and 25. As usual, our patrons, the users of our tool in myinvestorsheaven.com who have full access, can try all their numbers. If you're not a patron, if you're interested in becoming one, gain full access to our tool here, you can find a link in the description box below this video. Free cash flow margins, about 100% and more in some situations for Apple. So I'm going to go 90, 100, and 110. An annual return of 13% is what I like to use because you get about 10% from the S&P 500, pretty much, the ETF. And I hit calculate. Now you'll see that our low price that we'll be willing to pay for this kind of projections here is 85, medium 108, and high 134. And so if the company was near maybe 150, I think it would be much more interested. I would be much more interested. Right now, as it's approaching 180, I think it's a little bit more expensive, and I think I would potentially want to wait it out a little bit. So between Google and Apple, frankly, they are not that far apart. And given the estimates here, this revenue growth could easily happen. It's not so aggressive, frankly. I think it could easily happen for Apple. Both of the companies, both Apple and Google, in my view, are fairly similar to how they're priced right now, which is a little bit more expensive than I would like. So I would probably wait it out a little bit if I wanted to buy. Wait maybe for a decline to 150, 140 if I really want to get into the company. And at some point it could be less as well. Who knows? Maybe we have some steep decline at some point. It's possible. But right now, it's probably worth waiting for a while, just see how this proceeds through the quarters, see how the company keeps doing with their financials and their next earnings. And I think I will be holding my horses for now. Now, thank you for watching the video, guys. Let me know, again, which one do you prefer? Is it Google or Apple between the two? I'm curious to see which one is your favorite right now, which one you think is cheaper and better to own. And thank you for watching this video. I'll see you in the next one. Bye-bye.